The South African Reserve Bank, or SARB, has a clear mandate to ensure price stability while fostering balanced and sustainable economic growth. However, its cautious approach to interest rate adjustments raises concerns about whether it is doing enough to stimulate an economy that is grappling with weak growth, high unemployment, and structural changes. Hello, everyone, and welcome back to FinEd, your favorite financial education channel. Before we begin, please do us a huge favor and subscribe to our channel and help us spread financial education. And don't forget to hit that notification bell too. In this video, we will argue that the South African Reserve Bank should lower interest rates more aggressively to support economic recovery, reduce unemployment, and align with global monetary policy trends. Let's begin. Lower interest rates reduce borrowing costs for businesses and consumers, spurring investment and consumption. South Africa's GDP growth has been absolutely sluggish, struggling to exceed 1.5% in recent years, far below the levels needed to address unemployment and inequality. During the COVID-19 pandemic, the US's Federal Reserve cut interest rates to near zero levels to stimulate borrowing and economic activity. As a result, the US economy rebounded sharply, with GDP growing by 5.7% in 2021 compared to South Africa's 4.9% in the same period, despite stricter monetary policy by the SARB. If South Africa were to adopt a similarly aggressive approach, businesses could access cheaper credit, driving investment in manufacturing, infrastructure, and technology. With unemployment at over 32%, South Africa faces a labor market crisis. High interest rates restrict business expansion by increasing financing costs, limiting hiring, and discouraging entrepreneurs. Brazil, an emerging market economy similar to South Africa, aggressively cut interest rates between 2016 and 2019. This led to increased business lending and a reduction in unemployment from 13.7% to 11.6% over that period. If South Africa followed suit, SMEs, responsible for over 60% of employment, would have greater access to financing, leading to job creation. Consumers play a critical role in economic growth, with household consumption contributing over 60% of GDP. High interest rates lead to higher debt servicing costs, reducing disposable income and slowing demand for goods and services. The South African Reserve Bank's interest rate hikes since 2022, I believe, have directly impacted consumer spending. Retail sales declined by 1.5% year on year in 2023, and vehicle sales, often a key indicator of consumer confidence, fell by 4.2%. By lowering rates, consumers would have more money to spend on essentials, housing, and discretionary goods, driving economic momentum. South African households are heavily indebted, with household debt-to-income ratios exceeding 67%. High interest rates increase repayment burdens, leading to higher default rates and financial distress. In 2022, Turkey aggressively cut rates to support struggling businesses and households, ensuring loan repayment affordability despite economic headwinds. If South Africa adopted a similar strategy, distressed businesses could stay afloat, preventing mass layoffs and bankruptcies. A more aggressive rate-cutting strategy could weaken the rand, making South African exports more competitive. This is crucial for a country that relies heavily on mining, manufacturing, and agriculture to drive trade. China has historically maintained a weaker yuan, their currency, to ensure its exports remain competitive. This strategy has allowed Chinese manufacturers to dominate global trade. A lower repo rate would naturally lead to a slightly weaker rand, making exports such as platinum, gold, and citrus more attractive to global markets. High interest rates deter both domestic and foreign investment by increasing the cost of capital. Lowering rates would make South Africa more attractive for investment, encouraging capital inflows into sectors such as technology, infrastructure, and energy. India cut interest rates aggressively from 6.5% in 2019 to 4% in 2020, leading to a surge in foreign direct investment, particularly in manufacturing and services. A similar approach could help South Africa attract investors looking to expand in Africa, creating a lot more jobs and stimulating growth. The South African Reserve Bank's primary argument for maintaining high rates is inflation control. However, inflation has been moderating within the SARB's 3 to 6% target range, suggesting there is room to cut rates without significant inflationary risks. The European Central Bank began cutting rates in 2024, despite lingering inflation concerns, acknowledging that monetary tightening was excessively constraining economic growth. If South Africa follows this lead, it can balance inflation management with economic expansion. South Africa's government is facing fiscal constraints due to high debt to GDP ratio, which is over 70%, limiting its ability to implement aggressive fiscal stimulus. This places a greater burden on monetary policy to drive growth. The US Fed worked closely with the US Treasury during the 2008 financial crisis, ensuring that monetary and fiscal policies were aligned. The result was a faster economic recovery compared to economies with disjointed policies. Within SA, the SARB should align its policy with government objectives by ensuring lower borrowing costs to complement public infrastructure spending. While monetary policy alone cannot fix deep-rooted structural problems, high interest rates exacerbate these issues by stifling investment, limiting credit growth, and reducing business confidence. The BER Business Confidence Index has remained below 50 for years, signaling persistent pessimism among firms. Lower rates would signal that the South African Reserve Bank is committed to boosting business expansion and job creation. The South African Reserve Bank's legal mandate extends beyond inflation control to ensuring economic stability and growth. However, its overly conservative stance has resulted in weak economic performance despite stable inflation. The SARB Act states that the central bank must ensure balanced and sustainable economic growth. If rates remain excessively high, the SARB may fail to meet its broader responsibility to the economy. Just in closing, a more aggressive rate cutting approach would provide relief to South African businesses and consumers, which will spur economic activity and help combat unemployment. While inflation control remains important, current economic conditions suggest that the South African Reserve Bank has room to prioritize without significantly endangering price stability. If South Africa wishes to break free from stagnant economic performance, the SARB must adopt a more proactive monetary policy that aligns with global best practices and domestic needs. Tell me what you think in the comment section below. Do you think that the SARB is doing enough? Are they cutting interest rates slowly? Is it too slow? Is it not aggressive enough? Let us know what you think and what else can be done to stimulate this economy, which has one of the highest unemployment rates in the world. Thank you so much for watching. Please don't forget to like and subscribe to our channel and share this video so that we can get more views. Thank you so much, guys. I'll see you in the next one.